All right, so in this video, I'm going to talk a little bit about some market terminology. So specifically, let's start with money markets. Money markets are typically short term, generally less than about a year. Highly liquid debt securities are involved there. So if you think about a money market mutual fund, generally what they're investing in is short term, most of the time, less than around a year, maybe a little longer, but around a year. Highly liquid debt securities. By moving to the capital markets are looking at intermediate and long-term debt and corporate equity. So let's add some clarification here. You'll see some slightly different ranges used, but generally for intermediate, you'll see somewhere around 1 to 5 years as sort of the breaking points for intermediate term debt. Sometimes you might see closer to 7 or something like that, but somewhere around 1 to 5 years generally for intermediate term debt. Long term, generally greater than 5 years then. So think the standard bonds, notes payable, things like that when they're issued. Corporate equity is for the life of the company. So you're hoping the company sticks around for a long time. So generally for the life of the company could be for a very long time. And that's why there have been some situations where somebody inherited grandma's stock that she bought 45 years ago, and it's had a whole bunch of dividends and stock splits and everything else, and it's turned into a lot of money. And basically it was for the life of the company. The company's still around, still churning out money, and that's just there it is. Somebody made a bunch of money on that. So sometimes for the life of the company it could be a long time. Now there are also of course companies that fail, but generally we're assuming that it winds up being more or less longer term for the corporate equity. Now, in the case of intermediaries are basically financial institutions that facilitate the exchange between those who have capital to invest and those who need capital. Now, there are a whole bunch of different financial intermediaries. So think banks, savings and loan companies, mutual funds, pension funds, insurance companies, all kinds of different entities basically wind up serving in some form or aspect of an intermediary capacity. So let's kind of think about a bank for a moment. If, for instance, you are, let's say you've got $1,000 to save, you take the money, you put it in the bank account, you save it. Well, they may take that $1,000 with a whole bunch of other people's $1,000, and then they lend it out to somebody in the form of a mortgage so they can actually buy a house, right? So basically, you didn't have enough money to make a loan to somebody to buy a house, but between your $1,000 and a whole bunch of other people's $1,000, there was enough money overall in that group to now the bank can make a loan. And so essentially, that bank has facilitated that transfer between you who saved your $1,000, a bunch of other people that saved their $1,000, and somebody who needed the capital. Or perhaps they invested in a business, and it's the same kind of idea there. So intermediaries just basically facilitate that exchange and make it so that you can work with a smaller scale and yet still invest in a meaningful way. And mutual funds do the same kind of thing. If you had $1,000 to invest, if you were trying to do this all by yourself, there'd be a limited number of shares of stock that you could invest in effectively. But if you pick, say, a total stock market index fund, you can take your $1,000 invested into that mutual fund or exchange traded fund and wind up investing in thousands of companies all in one investment. And so basically that mutual fund is making it easier for the person with the money to save and invest and transfer that capital to entities and companies that actually needed the capital. Now, that leads to a little bit more terminology for the market. That's the primary market and secondary markets. Let's talk about that a little bit. Primary market. The primary market is where new securities are issued and the company is basically raising capital. So think of it this way. Primary market transaction means the company that is issuing the securities their balance sheet is changing. Okay. So think of an initial public offering. So if a company sells stock to the public at large, then basically they sell the stock, they receive cash. We've changed the company's balance sheet. Okay, so that's a primary market transaction. If it's a primary market transaction, the entity issuing the security is basically their balance sheet is changing and the company is raising capital. So issuing debt or issuing stock, the company's balance sheet changes with that. And the company involved is party to the transaction. That's the idea behind a primary market transaction. Secondary market transaction is where outstanding securities are traded between investors, and there's no effect on the underlying company's balance sheet. So let me give you an example. If I go out on the stock market and I buy a share of stock in Apple, Walmart, whatever, So if I buy a share of stock in one of those companies, I'm not actually buying that share from that company. So if I buy a share of Apple stock, I'm not buying the share of stock from Apple unless they just happen to be selling shares on that particular day, and I happen to get one that way. But reality is, I'm not getting a share of stock from Apple. What's happening is I'm buying a share of stock from some other investor. And so if I buy a share of stock in Walmart, same thing. I'm not buying that share of stock actually from Walmart. I'm actually buying it from some other investor who decided he wanted to take cash out his money and go do something else with it. So the vast majority of transactions that occur in the stock market on any given day are secondary market transactions. They are basically where outstanding securities that already existed, shares of stock, bonds, whatever, that already were in the marketplace. Those are being traded between investors. And so it's investor to investor that is making the transaction. Now, because it's investor to investor, there's no direct effect on the company's balance sheet. So this doesn't change the company's balance sheet. So if I go buy a share of stock in Apple, it does not change Apple's balance sheet when I buy this in the secondary market and I get it from another investor. It doesn't change the company's balance sheet at all. Now, importantly, does that mean Apple doesn't care about it? Well, no, Apple absolutely does care about it. Because if they are trying to maximize long-term shareholder wealth, and long-term shareholder wealth is very much related to the stock price of their common stock, then one of the things that they're going to care about is what's the price at which this transaction is occurring. And they want that price to generally be going up, which means people are generally becoming more wealthy as shareholders in Apple. So they're going to be very much interested in what's happening to the price of those transactions. But the transaction itself doesn't change the company's balance sheet because it's from investor to investor and it's a secondary market transaction. All right, hopefully this video has been helpful. Thank you so much for watching and have a great day.